I'm investing $100,000 of my own money into the stock market, and in this video, I'll show you how I plan to deploy it. Hey friends, welcome to the channel. This is the first video in a new series where I will try to grow this $100,000 into a multi-million-dollar portfolio. I want to make one thing clear. This growth will take years, perhaps even a decade. So if you think this is a get-rich-quick strategy, it ain't. I'm unapologetically a Warren Buffett-style investor, and I've done hundreds of hours of researching him and other value investor strategies, and I hope that I can share them with you. I should also mention that $100,000 is a lot of money to me. I'm only comfortable investing this much of my own money for two reasons. First, I've been an investor for 12 years. I started investing with hundreds of dollars, and then moved on to thousands of dollars, and then got comfortable with tens of thousands of dollars. I'm now at the point where I manage my entire portfolio, of which this 100K is a part of. The second reason is that I have my nest egg. This consists of two additional portfolios, the first being retirement accounts, 401ks, etc., and the second one being a portfolio of low-cost ETFs, mostly indexed to the S&P 500 and the Nasdaq 100. One of the secrets of Wall Street is that most hedge funds do not beat the S&P 500, and so I'm comfortable parking my nest egg in the S&P 500. If you're managing your own portfolio or thinking of doing it in the future, you must keep in mind your risk curve. Warren Buffett says risk comes from not knowing what you're doing. So research, read a lot, talk to others, and a great way to start doing that is by subscribing to this channel. I'm trying to build a community of value investors and even spent 2 years developing a platform with my co-founder, and we're getting close to our beta launch. There will be additional information in our bio. Please feel free to check it out. So back to my fund. What am I doing with the 100K? The answer is, I have no idea what I'm going to do with this $100,000. But the one thing I do know is I will not let it sit by and lose value as idle cash. Ray Dalio, founder of one of the world's largest hedge funds, has a very famous saying, and that is cash is trash. And this is because if our money is sitting around, it's losing its actual buying power due to inflation. We've been in a period of high inflation, with it hitting as much as 8% in 2022. But even with the historic rates of 2 to 3%, this is still a problem. My interim move to make sure I'm not losing value on my $100,000 is really quite simple. And I would be lying if I didn't say that my inspiration came directly from Warren Buffett again. Warren Buffett, or more specifically his company Berkshire Hathaway, is currently sitting on a cash pile of $130 billion. If Warren Buffett had left this $130 billion just sit in cash, he would have lost $10.4 billion in spending power. Just to put into context how much $10.4 billion is, Warren Buffett could have filled 2 Nimitz-class aircraft carriers with Gulfstream G6 aircrafts for that same amount of money. So of course, the greatest investor of all time would not let that value erode away. Instead, he parked his money in something he's been using for decades, good old T-bills. In case you don't remember from your high school macroeconomics class, T-bills are short-term debt securities from the US government that mature in less than a year. They're considered super safe investments. And so Buffett will protect himself and Berkshire Hathaway shareholders from the deleterious effects of inflation by using T-bills and maintaining a massive cash pile, which is referred to in the industry as dry powder. So when a golden opportunity arises, he can instantly invest without needing to liquidate other assets. Buffett affectionately refers to his $130 billion war chest of cash equivalents, T-bills, as his elephant gun. This actually pairs perfectly with another key Buffett methodology, and that is be fearful when others are greedy and greedy when others are fearful. The last time Buffett really used his elephant gun was in the height of the 2008 global financial crisis. Only days after Lehman Brothers collapsed, Buffett used his elephant gun to invest $5 billion in Goldman Sachs, whose stock was in complete freefall at that time. Not only was Buffett lauded as a hero for bringing some confidence back into the markets, but he also made a cool $3.1 billion on top of getting all of his money back in just 3 years following that initial investment. You can see this strategy from forever ago. Going back to his annual letter to shareholders, he first mentions his elephant gun in 1987 and has written about it dozens of times since then. So this is a pretty time-tested path. Right, so now that we understand the origin and the principle behind this investment philosophy, I'll show you how I'm putting theory to practice and keeping dry powder ready to invest as soon as I see an opportunity. Okay, here you can see just a little over $100,000. And I chose to put it inside of M1 because I like them as a brokerage, but then I also like their high yield savings account program. You can see here, their APY is 5%, which is just south of T-bill yield, which is around 5.28%. Now you may ask yourself, why not just get T-bills? And it's a very valid question. The high yield savings account under $350,000 is insurable by the FDIC. Warren Buffett obviously does not have that option with $130 billion. There are no institutions outside of our world's largest governments that could insure that amount of money. And there's no reason for any of them to. Because my money is insured by the FDIC, it is truly risk-free. Technically, no financial instrument is risk-free, but it is for all intents and purposes. And so for now, I've just chosen to park my money in the high yield savings account with $100 grand, 5% a year is an extra $5,000. We'll see if that outperforms inflation. Should be just about close. I have the sense that it will, given our most recent numbers. But most importantly, it buys me time to really look for that right opportunity. And that's the key point I want to drive home. You should never be in a rush to make an investment. The enemy is emotion. I want to finish with one last little bit of theory, and that is the risk-free rate. The question is, what is the risk-free rate and does it really exist? The answer is it doesn't exist in real, right? We could have a global financial crisis and the United States could default on its debt or not pay its interest rate, and I don't get that 5%. It's not guaranteed. So the risk-free rate is that theoretical risk-free investment that I mentioned earlier. Because my 100K is FDIC insured, we should assume that situation is basically zero. The reason why I bring this up is because it shows that investors shouldn't accept risk greater than our assumed zero unless the potential rate of return is higher than the risk-free rate. So this means when I'm evaluating where I'm going to move this money to, I need to evaluate something that has an extremely high probability of returning at least 5% in order to justify that investment. You can take this theory a step further and start talking about the capital asset pricing model, which in a somewhat roundabout way starts to discuss this idea of needing to outpace a risk-free rate. But this is something you should never calculate. This is again where I keep another Buffett quote in the front of my mind. And that quote is, read Ben Graham and Phil Fisher, read annual reports, but don't do equations with Greek letters in them. As long as you understand the concept of these theories, there's no reason to sit down and calculate this. As a former engineer and nuclear operator, I love equations, but when I'm evaluating investment decisions, you will not see me do one. The arithmetic of investing is extremely simple. Okay, to sum up, my investment strategy is a blend of my personal experiences, and I use the wisdom and proven track record of Warren Buffett as my North Star. I am not here just to pick stocks, but I'm in this for the long haul, and I would love for you to tag along. The company I'm starting is called Flank, and our mission is to decrease the wealth gap. Flank decreases the wealth gap by teaching and fostering a long-term Buffett-style investing strategy while making the analysis, discussion, and community engaging and accessible to all. This is my first YouTube video I ever put my face on, and probably right around my 10th video of all time. And so I'm new to this. So please, 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 in the comment section, give me your feedback. Let me know what you liked seeing, what you didn't like seeing. I'm really starting this at level 0. So I'd love for you to join early. Thanks so much for watching. We'll see you next time.